to all of you. I must say, welcome to Dubai, because we are based in Dubai and it is wonderful to see an audience from India as well as from Dubai to participate in this excellent section that PMS Bazaar has organized for the benefit of the industry and for NRIs in particular. I must at the outset thank Mr. Vikas for getting in touch with me early on to coordinate for this session, and Mr. Pallavarajan and his team for the wonderful efforts they have put in to have this session in play for the whole day. I think morning the session has been, I think the kickstart has been wonderful in terms of showcasing India as an investment destination, and to most of us, I think we have been following these sort of trends that has been happening in India. I think the one point that impressed me quite a bit, and the fact that we all have to understand being in this industry, is the finalization of the financial markets that is happening today. I think the numbers were quoted today. The AUM of the industry in terms of managed assets is about 1,35,000 crores. Insurance, that includes the insurance, the mutual funds, the NPS, the provident fund segment, the alternative segment, and the other managed funds that are happening in the public space. And this is bound to grow. We are talking of the GDP growing and the market growing in size to, say, 315 lakh crores in the next 5 years. And across all industry segments, we are going to see that growth. So what is fascinating in this entire journey is that I've been lucky to be part of the financial sector from 91 onwards, when I remember dealing with mutual funds, and those days there was only the UTI and a few public sector funds that were available in India. And after that, the whole process of managed investments have changed, and especially the last decade has been, I would say, a sea change that has happened in the whole space. Now, what makes this industry very challenging is, I think, I must thank the panelists for organizing this session upfront. It's only because of the fact that the fund manager has become the key component of this industry today. I think we should all accept that. I was trying to pick up some data to find out how many fund managers are there in India today. And I can at most make only a guesstimate based on whatever data is available. I'm told that in the mutual fund industry, there are about 400 plus fund managers. We have close to 400 PMS entities registered with SEBI. As of the day before yesterday, when I saw the SEBI site, I saw about 1,061 alternative funds are registered in India. So what is the number of fund managers that are there? That's a question that is sort of mind, but I think it's running to a few thousands. I would say maybe 2,000 fund managers in the managed investment regulated space. So end of the day, when we talk about what Mr. Vikas mentioned about giving you that alpha in your investment, it is these people who are going to do that. And believe me, I would not like to be in any of their seats. It is the most challenging job that a fund manager faces in India today. Because end of the day, when I have the opportunity to meet many people across the global segment and from India on a regular basis here in Dubai. And it's sort of mind-boggling to understand how are they going to achieve the sort of performance and the yardsticks that they set for themselves. So it is in that context that I would like to start the session with this esteemed panel of members who have already been introduced, and they're all doyens in the industry. I was just looking at their profiles, and we have on stage more than 75 years of collective fund management experience, people who have been in the markets for decades, and it will be very interesting from a perspective of investors to understand how the fund management industry and how fund management as a proposition is to evolve and move forward in the next few years and decades as well. So I would start again with a basic question to all of you. I think Mr. Madanagopal can start in terms of the whole process. I mean, from this context, how do you see fund management as an activity with from a personal perspective, from an organization perspective, and from an industry perspective, what do you feel is the role of a fund manager today, and what are the challenges that you face on a, I would say it's now a day-to-day basis. It's not even a month-to-month or a week-to-week basis. I would like each of the panel members to start off on that before we get into the specific questions. Thank you.
Thanks, Mr. Krishnan. Good morning, all of you. I'll restrict to what the alternates business is trying to do in the fund management space. If you look at, because in this presentation highlighted what are the emerging opportunities to make money in India, right? He talked about how China exploded after $2,000 per capita income as a large consumer, consuming country. He talked about how manufacturing can become a very big opportunity when countries cross this milestone. And also specific to India, he referred to how India can be a thought leader in digitization. So if you really want to play these themes, I think just to get to some points on how our indices and how it is structured and where fund managers can play a role on being very selective sort of investment. If you look at our large cap index, which is Nifty, you will not get a chance to play many of these themes. So the fund manager comes in here and he can create a portfolio, and particularly an alternates fund manager who has no benchmarking sort of an approach. So we don't look at benchmark when we select stocks. We look at stocks on a standalone basis, whether they have potential to deliver a higher returns to the investors and deliver a higher growth to the investors. So from that perspective, alternates particularly, and Sundaram alternates, we are benchmark agnostic. And that will play a major role because today in the benchmark, most of this emerging theme, if you want to play consumer discretionary, urban consumption, which can explode, and that's what we have seen in other countries growing multifold after they cross $2,500 per capita income. India can reach a $5,000 per capita income in next 7 to 8 year time period. A majority of this additional $2,500 is going to be spent on discretionary items. So if you want to play that, in Nifty, you have just autos companies. Except for Titan, there is no other discretionary stock in the portfolio. There are plenty of mid and small cap discretionary companies which are doing really well. So how do you really play it? If you play a passive Nifty index, or if you're playing with a very diversified large cap fund, you are restricted from your opportunity to participate in this growth. We talked about exports and areas where like IT is a large cap sector. But if you look at sector which has done really well in the last 5 years, it's chemicals, specialty chemicals. You don't really have the opportunity to play that in the Nifty. So what we are trying to do in Sundaram Alternates is we are looking at certain themes which are growing really well, much better than the overall growth in Indian GDP case itself, and enablers of this building block of making India a great story over the next, say, 5 to 6 year time period. And then when we look at it, a lot of these opportunities are not even in the indices. So we go outside benchmarks. A lot of our portfolios have an overlap with indexes, not more than 15-20%. So we go outside and then search for those ideas and build a portfolio. And that is the best way. And this portfolio will definitely have an opportunity to grow much faster than the Nifty index. So what we see is our portfolio's earnings growth has been around 20%. And Nifty has been delivering a 10% sort of an earnings growth. So when you create such a portfolio, you create an opportunity to create alpha for the investor who comes in with a long-term approach. And that is the reason which has really played out well for Sundaram Alternates, that over the last 12 years, we were able to create a 5 to 6% alpha across most of our portfolios.
Yeah. So I think fund management industry has always been challenging. If you ask me 30 years, it is across cycles, whether you take business cycles, profit cycle, economic cycles. The core focus, the core mantra of every fund manager is to stick to the basics, which we all are, either through experience or through the core 101 finance. I've read it. Quality investing, a lot of people say. But my experience in the past has said the key challenge is to understand the balance sheets. So we primarily over time have, changed into a balance sheet kind of investors. And other key component, if I have to say, is I have seen a lot of companies languish around low P multiples. They will languish at 4P, 3P. But the challenge is the stocks prices are not moving. There might be value in the books. So what we do is our effort is to look for catalysts, the triggers that can help us unwind those values. Otherwise, in my previous role as a hedge fund manager, I held on to a stock, 2% position of the company for 7 years. It was at 3P and it remained at 3P, and it went through different cycles, and the returns were almost nil. So we always look for some catalysts, some triggers which can help us unwind that value. So the whole exercise of our research process is to find the disconnect between the price and the value, and the steps the management is willing to take to achieve or to fill that gap. That is very critical for us as a fund manager, as a research house, to invest in those securities. In terms of time frame, we fund managers, our performance appraisal is done on an almost daily basis. So this is a big challenge for all of us. Sometimes we have to answer why this, indices are up, you are down. So my request to all our investors is always to have a long-term time frame. When I say long-term, because things, do take time, and the triggers, the catalyst, on whatever changes we are looking for, whether that is the capital structure, whether that is in the financial profile, whatever may be the reason, or whether they are passing through a different, environment, that takes time. So long term, we need to have a 2-3 year time frame. And lastly, I would say sometimes the investing can be boring, can be challenging, unexciting, a lot of unnerving for all of us. But one mantra which has helped us make money throughout is obviously stick to quality, which is very common. But what is quality? I think the growth and ROE, the combination of these two factors, the capital efficiency and growth, leads to a money-making machine for all of us. So that has been my journey, I would say.
My take on fund management industry would be that I think the biggest challenge we face today is to embrace the global economies which are changing, the global investment landscape is changing. We all are well versed, we all are good in identifying companies, we know the sectors, we know the strengths of India. But as India is growing, while the economy is domestic and inward looking, investing in India is also not really just domestic. You need to now be aware of the international trends, the global trends, because the world is changing fast. Out of the 100 rupees of market cap, half of the market cap is owned by promoters and the government of India. And out of the balance half, 50% is FI ownership. So as far as the sentiments and the liquidity is concerned on a day-to-day basis or in a near-term basis or in a 2 to 3, 4-year basis, Indian equity markets tend to track or tend to follow how the global sentiments are. And as a fund manager, the biggest challenge that we face today is not just identifying companies, but also identifying global trends which are changing very rapidly, and how do we adapt our investing style? How do we adapt our way to look at companies in this global perspective? Because so far, the fund management industry in India was also very inward looking. We just looked at local companies, we just looked at local data, we just focused on quality, growth, and we invested. But as we all know, investing is 50% fundamental, 50% is EPS earning, the half is P, which is the multiples that we give. This multiples is something which is now becoming global because the money is global, and we need to realize that. And that is something which I believe is the biggest challenge the industry is facing today. Not many of us are well equipped or even thinking on those lines. And to me, in the next few years, this is something which is going to differentiate a good fund manager versus the others. So for me, that would be the biggest challenge the industry is facing right now. But at the same time, we are all well aware of this and we are all moving towards it. And I'm pretty confident that the way Indian economy is doing well, Indian equities and the Indian fund management industry would also be able to give a sustainable and a meaningful performance.
Namaste, Dubai. Good morning to all of you. Thank you so much to the organizers, PMS Bazaar, and thank you for all of you for coming here. It's a great opportunity to be present here and talking to you. So, Krishnan, you raised the question about the fund management and the challenges around it. I just want to touch upon, how being in the alternate space, we can overcome some of these challenges and be able to better deliver. So, I agree with Madan, when he mentioned that in a lot of fund management industry, there is a lot of pressure on the fund manager when he's benchmarked to a certain index. Okay. And you have trends playing out, like he mentioned, and Vikas mentioned that now the GDP per capita is taking off. Okay. And you want to play that trend, and there are very little stocks in the index to play that. So what happens when we are on the alternate side, we can be able to play a lot of these trends very, very well. And I want to give you one example. Okay, so see, 10 years back, if you were positive on a real estate sector in India and you wanted to play real estate sector, you had to maybe go necessarily and play DLF or Unitech. Okay, there were very little options. You had to go and play the main guys who were doing that work. Today, you can go and play the ancillaries. You can play the wood panel sector where Century Ply has reached a critical mass. He's 10,000 crore market cap, generating 600-700 crore of EBITDA. And there are 5 companies in the wood panel sector which are directly linked to the real estate cycle. And they are much less volatility in earnings and much better balance sheets. You can play a plastic pipe where Astral has been a multi-bagger. There are 2-3 new companies which are coming in. You can even play a mattress player like a Sleepwell. Same way in the BFSI space, 10 years back, you could play only banks. And there was only one NBFC, maybe HDFC Limited. Today you have 5 life insurance companies listed. Today you have 3 asset management companies listed. Today you have 2-3 wealth management companies listed. And you have even depositories and stock exchanges listed. So I think rather than the challenges, how I see right now is when the fund managers are not, too much benchmarked to an index, like in the alternates, we get, money for little longer term. It's a locked in money. We are not raising money every day, like in the alternates, and there is no pressure of incoming, outflows, like which is there in mutual funds. We can bet on these trends. Believe you me, now there are around 50 subsectors in India across all the sectors where you can, build a very nice portfolio of 15-20 stocks. And because the India story is much, much stronger, I firmly believe, and what Vikas showed was obviously, completely an eye-opener for what can come in. We are able to kind of overcome the challenges and build a 15-20 stock portfolio across these assets and make it a little bit more enjoyable experience with less pressure. Having said that, it doesn't obviously mean that the job is any easier. All I'm trying to say is that now we have options to add value to the investors in a much more balanced way. And that's how kind of I look at and our fund approaches the investing into the Indian markets to be able to play on these trends in a much better way through much more less volatile and much more stronger companies. Thank you.
Thank you for setting that perspective. I think the clear message that keeps coming out is that the alternates space is different from what we normally expect from the market, and it's not linked to any benchmarks for performance. It is pure quality or value investing that matters. So let me, in that case, get back to specifics to understand the style of each one of you in terms of how you are managing the funds that come under your management. Mr. Madan Gopal, you have mentioned something like a 3Q filtering process, and can you explain how that process works, and what is it that goes into the analysis and judgment call that you make before you pick up a stock?
Thanks for that. So basically, the thought process is that whether you can identify a company which obviously we are not looking at any stock with a 1 or a 2 year sort of a perspective. So we want some company which where we can invest and then play through the cycle and then make the best out of that investment. So the minimum target that we do is, can we double money in that idea? We are not investing into any stock. where we are looking at next 20% return or a 30% return. So obviously, with a 3 to 4 year time period, can the stock double? So we are taking a 4 to 5 year sort of an approach. When you do that, obviously you cannot invest into companies with a long-term perspective unless they are growing really fast. So the entire 3Q approach is to whether this company has potential to double its earnings in 3 to 4 year time period. If that is the case, where it can come from. So obviously any company can grow superior compared to overall economy only if it has a large target addressable market. So to start with, we don't touch any company, or 95% of our investment will be in those companies where the target addressable market will be 10 times the size of the company which we are investing at that current situation. So for example, I'm taking a name here. Say, when we looked at Titan, say 7 years back, all of you might be thinking Tanishq is a very large jewelry company, right? In India, it's a market leader. But the market share of Tanishq, when we picked up, or Titan, Tanishq is the major value creator in Titan. Titan was just 5% market share of the overall jewelry sector in India. So there was a large market for Titan to keep growing. So it clicked our first point that there is a huge market in front of this company for them to grow. The second point that we want to ensure is there is an opportunity to grow, but what is it Titan has to do different to keep growing and gaining market share? Because it's see, overall jewelry consumption in India might be growing in single digit or even low single digit. So Titan has to keep gaining market share from unorganized players and even from organized competition. So the point that came out very clearly on Titan is Titan's ability to use its brand as well as designing capability that it brings on the jewelry is able to make Titan earn EBITDA margin substantially higher than the next best player in the market. So to give an example, to give some data, Titan EBITDA margin is equal to the gross margin of the next best player. And in a sector where you almost, the business is about how much inventory you maintain. And it is about 3 times the inventory that the business does. So 3 times and almost 10% additional margin. You can do the mathematics to see how much return Titan generates for every 100 rupees that it invests into the inventory. What it helps Titan to do. So this keeps Titan's profitability much superior. So that second point is also clicked. But what is it really has to do is how can Titan grow? When we picked up Titan, Titan had roughly 150 stores in Tanishq. And they were present in some 50 cities. And from our mapping in various other consumer facing businesses, what we understood is Titan can reach potentially somewhere like 150 cities over next 10 years. Today, Titan is in 110 cities with 400 stores. I'm talking about Tanishq. Titan's watch business is not a very major value creator, but just at Tanishq alone, from 50 cities, they have moved to 110 cities. From 150 stores, they have moved almost to 400 stores right now. They are now becoming global. They have went and acquired new businesses like Carrot Lane, which they have transformed it in a big way. So what really happened is there was a large market to gain. That is the first point. Second is there is a company which is making much superior profit than its competition. It is generating a lot of cash. The cash is not kept idle. The cash is infused back into the business. That keeps the engine of growth active. So any business which can do this over a 4 to 5 year period has a potential to beat in terms of earnings expectation. And when people look at 1 year, they generally miss out this entire Titan story because they look at the valuation and they think it is extremely valued. But the moment you look at the 5 year growth in front of you, then Titan would have been a buy any time in the last 4 or 5 year time period. People ask me, is it better to invest in gold? I tell them, gold probably in 4 or 5 years would have given you a 50% return. Titan would have given you almost 6 times return. Why? It gives the benefit of gold price increase and market share increase. And also, it also protects you from inflation. So I'm just giving one example to explain what are the thought process goes behind this 3Q framework before we invest into a stock.
Mr. Arun, one of the themes that you have mentioned in your company is the Buffettology way of investing. Can you please elaborate on that? And I would also have a follow-up question at the same time. I also find it interesting that you are managing special situations fund. For the benefit of audience, can you also explain what is a special situations fund, how it operates, and what is it, how is it different from a normal fund that a portfolio manager or an AF manager is managing. So I have two questions for you.
Sure. I think I will take the second one first. Buffetology, I think we all understand what it is. But special situation investing, as I think the first speaker mentioned, my colleague, it's a big chunk of the US market. It's gaining traction. How do we do at CapGrow special situations? I think special situation for a layman investor is triggers when there is a corporate event. Corporate event, corporate announcement by the company in terms of a merger. I am going to give you certain example situations. What kind of corporate events are there? Mergers, demergers, spin-offs, buybacks, delisting. So our CapGrow special situation strategy just focuses on these situations. This also includes distressed securities. This also includes broken IPOs. When I say broken IPOs, there are a lot of IPOs which came in 2018-19 when the markets were booming. We would not look at them. When those stocks are at 1/3 of their original prices, IPO price, then that will come under our radar screen. That doesn't mean that we will start investing. So special situation is a transformational event in the life cycle of the company which we are monitoring. And what that transformational event will lead to is change in the earning profile of the company. And how would that change in the earning profile of the company would come from? Either change in the capital structure, because as I mentioned, it's a balance sheet investing which we focus on. So there will be changes in the capital structure that could actually lead to the earning changes in the earning profile. And a lot of times we have seen, when I say capital structure, either somebody is infusing a preferential or a multinational company is going to take over, which the impact would actually happen in the next probably 12 to 18 months. This strategy is very niche, very differentiated strategy from plain vanilla investing. And what we do is, then on top of this, we apply a second layer of Buffetology, just a sanity check, because sometimes these corporate events are announced and how the promoter is going to behave. We also try to apply the behavioral aspect, what has been the past behavior, the past data points of the management. Because in India, we all are aware that we need to focus on the management's, the integrity part. So Buffetology is just the second layer on which we focus. Our prime objective is to identify situations where there are events. And how this event leads to results is the changes in the earning profile. These returns are uncorrelated to the market movements in the medium to long term. When I say correlated, because here at CapGrow, we are not in the business of forecasting the growth for the company. GDP growing at nominal 6.5, 7, you will get a nominal value of real GDP 6.5, 7, nominal 11, 12. There are companies growing at 15, 20%. But we are not in this strategy in special situation forecasting. If the raw material changes, we don't know, we feel we don't have the best expertise to understand how copper will behave in the next 6 months. Where are the inventories lying? How the iron ore would. So the complete focus is on just the event that will have an impact on the earnings profile, and hence these stocks are uncorrelated to the market movements. And hence, if you see, because they are uncorrelated, they provide a diversification to the client's portfolios. In terms of the number of stocks, we have around 15 to 20 stocks. And most of our largest positions do not have any overlap with any of the portfolios. So most of our investors have mutual funds, have PMSs, AIFs, but our stocks through this strategy, you will rarely find in even the top 10 holdings of this. So I think that's our strategy, and Buffetology is just a second layer, just a sanity check to make sure that we are not getting into a wrong situation. Sometimes we have invested in small cap, mid cap also, but whenever we invest in small cap, we do only public markets. We make sure that the liquidity event is provided by the company. We are not dependent upon the liquidity of the markets to provide us an exit. So if there is a buyback and we see a 20-25% arbitrage, we probably will be a big player there because the exit will be provided by the company and we are not dependent upon the markets. Thanks. I hope that does give you some insights into what we do.
Thank you, Mr. Arun, for giving a different perspective in terms of how alternates make a sense for investing into these categories of assets as well, which otherwise would not be available for a normal investor. Mr. Aman, you have a diversified alpha fund which looks at across categories, large cap, small cap, mid cap. And your basket of investments are also is pretty large in number compared to what we normally hear from fund managers to say that we would like to have a contracted portfolio. So how do you try to give an argument to say that having a diversified larger number of stocks makes sense, and how does it, and how you as a fund manager are you delivering returns to investors in your funds?
Sure. See, one of the biggest thing of alternatives is that the fund manager can play by his strength. He is not bound by a platform or a corporate that where AUM is the focus or profitability is the focus. In our firm, like all other alternatives, returns and staying true to the strategy is the focus. Keeping that in mind, we can play by our strength and feel that our strength lies in having a diversified portfolio with the right balance rather than having a very concentrated portfolio. Most of the PMS and AIF in India gets marketed on concentration. We'll have a 10, 15, 20 stock portfolio. We feel it is too concentrated for our comfort because we feel that concentration is a double-edged sword. If it works very well. If it doesn't, it cuts you equally bad. For that reason, we feel we need to have a slightly more diversified portfolio. So we have a 30-35 stock portfolio. In the last 4 years of our existence, all strategies that we manage and the returns that we have generated are all come from a 30-35 stock portfolio. The reason we have this diversified portfolio is that we do a lot of mid-market investing. And as we all know, the liquidity profile of a mid-market stock, a mid-cap or a small cap, is significantly different than a large cap stock. So keeping that in mind, we feel instead of having a single stock which is 7, 8, 9, 10 or 15% of the portfolio, it is much better to have a stock which is 3 to 5% of the portfolio. That gives you a better risk-reward equation, which is core to our investing philosophy. Anything and everything that we do, any stock that we have invested into, for me, the core of the decision is what is the risk-reward equation. We have a very clear belief that a great company need not necessarily be a great investment. A great company, we all know the HDFC banks of the world, the Asian Paints of the world. They are all great companies and nothing against them. But we are here to run a financial product. We are here for a financial return, not to get the medal of owning the best company. I'm here to get the best financial return possible. And that will happen only when I buy a great company at an equally great price, which practically speaking is not easy, right? You don't get a great company. It's only in theory and in marketing presentations that we will invest into a great company at a great price. So practically speaking, when you have to go down and you have to invest, you have to strike a balance somewhere. And for us, that balance comes in having a 30-35% portfolio rather than having a 70-80 stock portfolio a mutual fund offers versus a 10 to 15% concentrated strategy. So that's what our sweet spot is. That's what our strength is. And we would like to play by our strength. And that is the reason you mentioned the fund that we just launched. So it's going to be a 40 stock portfolio. It's going to have equal representation of all the 4 segments of the market, which is large, mid, small, and micro caps. At the same time, we understand the liquidity profile, the risk reward profile of each of these 4 segments is different. And for that reason, we are going to have a very disciplined approach. For example, say large caps. We'll have 10 stocks of large cap, but we'll take 4% exposure in each of these 10. So 40% of my fund is going to be large cap. When I come to mid caps, it's going to be 3% each. So 30% of the portfolio will be mid caps. When I go down, small caps, because of the liquidity, I'm not going to take a larger exposure, hence it will be just 2% per stock. And when it comes to micro cap, it's going to be just 1. So this is the 40, 30, 20, 10 approach that we are going to follow in a very disciplined way. And hence, we feel this will be the right approach for anybody looking at all the 4 segments of the market.
Thank you. I think it's a very interesting perspective to say. I think the audience by now would have realized, that each fund manager has his own perception, has his own style, and ultimately that is going to be, like I mentioned before at the introduction, that the role of the fund manager is going to be the key in what alpha returns that we're going to get. I'm coming back on the same question, Mr. Abhisar. Now, I think you probably have some 200, 250 stocks in your investment horizon, and then you have a filtration process to do that. I think if you can articulate how your model works and how do you look at stock picking and delivering returns to clients.
Yeah, sure. So Krishnan, see, in terms of the stock selection, because ultimately for an alternative fund which is working with either say a 20 stock portfolio, which is what we do, or even a 15 stock portfolio or a 30 stock like Aman mentioned, it's very important that the stock selection is done very, very carefully. And what we do here is that we have formed a AQCG filter, which is accounting quality corporate governance. See, thankfully, with the advent of data analytics and a lot of databases, you now get the data for the all good top 1500 companies in India through the databases, which will give you all the annual reported data to the last, kind of detail. What we have done is that we have automated a filter named as AQCG, which takes into account 14 parameters, which judges the governance as well as accounting quality of these companies on a quant basis. Okay, it's not as if that we, after that getting that score, we don't do the ground check on the promoters or the quality of the promoters or the standing of the promoters or how they have delivered. We also look what they have said and what they have delivered. But this score initially on the reported data of last 8 to 10 year financials gives us a very good kind of a view about how they have been doing things, into the numbers. And these have parameters like how much of bad debts have happened, how much is the volatility in depreciation rate, how much is the impact of the miscellaneous expenses on the EBITDA, how much salary promoters keeps taking even when the profitability keeps going up and down. So this tells you a lot, and this brings down our focus list down to, say, credible 150, 200 odd companies. Okay, and this score we obtain every year. So the list keeps on fluctuating a bit, but we get the list every year after all the 800,000 annual reports have come in. And the second and third filters are basically in terms of how strong the business model is. And we judge that by looking at the cash flow statement, whether compounding is happening on the cash flow statement or not. So we don't want a very good looking P&L only as the source of finding the good companies. We try and look at the OCF, operating cash flow level. We normalize it for 2 years because each single year of OCF can be little up and down for working capital. We normalize it. And then over 3 year, 5 year, 7 year, we want a double-digit CAGR there. Early double-digit is also very good, by the way. Because on the OCF side, when you go, you will find that the CAGR percentages delivering companies will fall materially. On P&L, there'll be a lot of companies will be delivering very smart-looking CAGRs. So this is what we do. And then, of course, the next is looking at the return on capital or from an incremental capital point of view. Whether, incremental capital deployed in the business in last 2 years, 3 years, 5 years is showing a very decent kind of a high number or not. And this is how we drill down, Krishnan. Then, of course, we go and try to do the bottoms of work, meet the companies, look at the sustainability of the earnings growth, the TAM in the market, like Madan spoke, very, very important parameter for us too. And then come down to that 15, 20 stock portfolio. But the beginning for that focus list is something which is very important for us, which we do through that filter which I talked about, AQCG, and also through these 1 or 2 filters. So that's how we go about it, Krishna.
Thank you. I think we have understood the individual styles of each of the fund managers here. I think we are a little running short on time. So I would just get back. I think the audience will also be interested in to hear some sort of specifics or recommendations or ideas that you have for the year ahead of you. I think the budget has come and gone. There is a lot of questions on interest rates that is happening. The global scenario looks challenging in terms of the US, Indian markets. So from fund managers' perspective, how much of these macros do you have to consider considering the India growth story in terms of how our companies are performing. So what is your outlook, or at this point in time and early 2023, what is your outlook in terms of where the markets you think are going to be headed, which sectors you would be looking at? I mean, that is something that I think the audience would also like to have some sort of thoughts from your side. So each one of you, if you can share a few minutes on that, please.
I'll go first.
Yeah, please.
So obviously, uh, when you are looking at investing long term in equities, the lot of noise that is going on right now in terms of inflation, interest rates, definitely matters from a timing perspective. But if you really ask me whether it matters when you are looking to invest from a 5 to 10 year perspective, uh, it can save maximum, say, 10% of getting into the market at the wrong point probably. But otherwise, the entire focus is mostly on what sectors are doing well, which businesses within those sectors are doing well, and whether the management can be trusted to execute the growth plans. I think that is simple that we try to keep. But yes, we also keep an eye on all the macros that are happening at this point of time, just to help the investors to go through that phase. But really, do we have any say on that? Nothing. So we just try to tell them that, yes, this is going to happen, but this is not the end of the story, right? Inflation have been going up and coming down since the time of period economics has come in. And it is going to happen the same way in the future also. Oil prices spikes, it creates problem in India, the rupee depreciates, and it creates a lot of apprehension among investors, particularly NRIs. But we keep telling them, just look at it, even despite that, as we shown in one of the slides also, despite that, India has potential to deliver higher growth and returns to the investors. So you have to just cost through those phases in terms of high inflation. If you ask me, people ask this question of whether during inflation we should shift to debt and come back. It's a very difficult question actually to, if you look at debt, at best it is able to compensate that particular year return from inflation. If you are capable, you can come back to equity at the right point, but is it so easy? You generally tend to miss the first leg of the cycle growth, and it can be really sharp. Because when the market shifts, market don't wait for the economic data to come down. Markets move to equity much ahead of when the inflation number really starts coming down, because they look at various other indicators to show that whether inflation is starting to come down. So they don't wait for the US CPI inflation or India CPI inflation to come down next month before they act on it. So it is generally difficult for people to move. So what I say is, you listen to what is coming in the media and all this, but I think at the end of the day, if you're looking at from a long-term perspective, I think these are noise. From macro, what is happening in India, manufacturing has not been helping India in the last, say, so many years, been very disappointing. But post-COVID, there is a clear shift. The shift can be two reasons. One is globally, everybody is looking at creating a supply chain outside China, and it is very, very clear. And when we talk about, when we talk to companies in chemical space, when we talk to companies in auto space, whenever the next leg of capex happens, and it may not happen in 2023 due to global slowdown, it might happen in 2024, it looks like. Whenever the next leg of capex happens for global companies, definitely the counterparts in India, whether it is the subsidiary of that company in India or a company which is already outsourcing or supplying products to those companies, are clearly seeing additional capex announcements. But that process has begun. Therefore, manufacturing, which was going through a lot of volatility in the last 10 years in India, could be a structural slow. It can pick up momentum and sustain at least a 5% sort of a growth going forward. That can create a lot of new opportunities. Obviously, a lot of it is factored in India right now in terms of valuation, but I think a lot of new opportunities are going to come in that space from an investment perspective. So that I see post-COVID as a new phase that India can play an active role in manufacturing as well as exports in specific sectors, and I think that trend change that we can see. In addition to other things that we have seen, one more thing that we have seen is digital opportunities have come in India now to participate in tech platforms. In 2020, a lot of these companies came, 2021, when a lot of these companies came for IPO, the valuations were very stiff and people were investing into it without any margin of safety. So that was a very clear face of greed. Today, that greed has changed to fear. Because the stock is falling, people are not looking at the business, but just looking at the stock and getting a lot of fear. I think tech platforms, if 10 goes like this, a lot of them will become a value opportunity. So, be sure that from whatever we have seen, that the tech initiative that is happening in India is definitely kind of creating a lot more opportunity to invest as well. So these are two emerging things that we are seeing post-COVID that is very clearly visible in India.
Thank you. Mr. Arun, and
Yeah.
in specific to your special situations fund,
Sure.
and in terms of the regulatory framework that you see that can impact in the coming years from
Sure.
on this.
I think in terms of risk, I will just spend a minute there. I think the risks are known to all of us. Equities itself is a business of uncertainty. You know, the interest rates, geopolitical risks, domestic issues, lack of growth, higher interest rates actually are killing growth in the US. And that's why, you know, our cap growth special situations is a differentiated one where we are not betting on macros. So the events are the focus area. And if, let's say, the markets are crash, you know, nobody knows. People keep on asking whether there can be a crash or not. My personal view is that the market, nobody is leveraged, neither the corporate balance sheets, neither the individual investors. So the probability of a catastrophic crash is low. There might be a softer landing even in the US and in India, but India continues to be on a growth trajectory. And if it at all happens, we have seen in the past when the markets crash, there are a lot of managements who come with their buybacks, their delisting proposals. When the COVID happened, the largest, metal company came out with a delisting offer at a lower price. IT company came out with a delisting, which gave them which the final price delisting was 100% more than the quoted price. So if at all happens in those situations, we have our own special niche opportunities of buyback, delistings. If the markets do well, then there are a lot of mergers, demergers, and a lot of companies try to raise their stake promoters, and they provide us an opportunity. So overall, I think, the largest NBFC and the bank are going through a largest merger of the decade. So there are ample opportunities which are scalable in the Indian market, which provide us opportunity to lower the risk and have a superior return profile.
Thank you, Mr. Aman. What are your thoughts in this?
Sure. So, while we all do long-term investing, it is also equally important that we survive the near-term and the medium-term. And the way we do it is right now, say in the market, if you have to take a call on the market as to what are the risks. All that people have been discussing over the last several months has been inflation and interest rates. I think interest rates is well known. We all know that we are the flag end of the interest rate cycle, and maybe a last 1 or 2 rounds of interest rate hike is pending, post which is going to be a declining phase. When it will happen, we don't know, but that's where the trend is, and we all know about that. And hence, I don't think equity market is overly worried about that. What it is currently worried is inflation, and by inflation, what I mean is that what is the demand impact of the inflation? Whatever word we use, stagflation, recession, depression for European economies or American economy or any other economy, ultimately what you're trying to figure out is what has been the demand impact because of this high interest rate and inflation. So from that perspective, I think in the next few months are going to be challenging because we'll get clarity as to what has been the demand impact, whether there is a hard landing or a soft landing. Post which, I think economies will stabilize and markets will also then tend to look at a new base and from there start to move on. Thankfully, as far as India is concerned, we all know the positives. We all know that we are in a much better shape compared to most of the other regional as well as local economies. And from that perspective, I feel that Indian economy will do well, and that will ultimately get reflected into equity returns also. Something that people keep on asking us is that FIs have been net sellers over the last 12 months, and this is something that we have not seen for more than a decade. And what's the real reason, and will they come back? I can say that I'm 100% sure that they'll come back once the dust settles in their own respective geographies, in their own respective homes. Once you start to look at a global investing standpoint, what are the options that you literally have? If you come to look at Asia, Sri Lanka, Pakistan are bust. Bangladesh is in bad shape. Nobody wants to increase their weightage to China after the regulatory clampdown there and after having lost money. Middle East is completely oil dependent. Turkey, Greece, Portugal, hyperinflation. Europe, the Ukraine crisis is still on. UK, every 6 months, the PM is changing. Economic like Indonesia, Brazil, completely commodity driven. And as we know, more than half of the commodities prices today are even lower than the pre-COVID levels. So then there are a handful of opportunities left if somebody has to look from a global standpoint, maybe a country like a Philippines, Malaysia, Thailand kind of thing. And within that, India stands out, not just because of the sheer size of the economy, the sheer potential that we have, at the same time, the leadership that we have. After a long time, we have a very strong and a capable leadership there. And I have no doubt that the central election, which is due in the next 18 months, the current government is coming back. And if that is the case, then we are headed towards a much stable environment and a very proactive government which can take care that the growth rate will accelerate from here on. So that is a big macro trend that I am looking forward to. And I'm pretty confident that Indian economy and hence the stock market will continue to deliver what it has delivered in the past.
Yeah, Mr. Abhisar, what would you say? I mean, there is also from your perspective, but do you also feel that given all these circumstances, that this is the year that one should think in terms of accumulating and start investing at this juncture rather than waiting for things to pan out in the future? Your final
Yeah. So Mr. Krishnan, if you look at the index, okay, right now when we are sitting in 2023, the index for the last 18 months in India has been almost flattish. We made 18,500 as the high in October 2021. Now, 18 months later, we are 1,000 points below that. And in this 18 months, on the fundamental side, on the EPS growth side, things have been going better only for India. Maybe there have been a few hiccups in between and some of the macro events like the interest rate hikes in a big way, Russia-Ukraine war have come in. But our story has got overall stronger. At that time, our multiples were little higher. You know, we had kind of rallied all of a sudden. So the multiples were, say, very stretched. And a lot of people were at that time saying that don't look at index multiple for India market. Index no more maybe is representative of the economy, etc. And so it's justified. But at the end of the day, that correction in multiple has happened for the index, with index not going anywhere, maybe 1,000 point lower. Fundamentals have further improved. As you know, my peers have mentioned, the India story is looking the best in the whole context of the globe, given how Russia and China things have panned out there. And in that sense, I think we are now very, very well set up. After, you know, the interest rate peaks at some point, I don't know when, maybe like as Aman mentioned, 1 or 2 hikes more, we would start tracking at least our earnings growth, which is also looking early teen to mid-teens. And if we get any bit of re-rating, we'll do maybe, you know, even better. So from here, we are decently constructive on the index. Also, I want to mention, you know, from an index and the Indian view perspective, it's very important to look at how the domestic investors in India have now become very strong. So a lot of people will be surprised to know here, we keep talking about FIIs and the FII flows being very important because they have been historically very important for India, right? But now, the last 3 years, cumulative DII flows is 7x of FII flows. 7x because of the last year big negative number of FII. Last 5-year cumulative flows of DIIs is almost 2.5, 3x. And last 10-year cumulative flows is also higher for DII. DIIs come of age, you know, SIPs, despite all the 18-month volatility, correct, it is gone from 7,000-8,000 per month to 13,000 crore per month. That's $1.5 billion a month. So I think this will also support the market's valuation and the market's trajectory from here. And as such, I think starting second half of this calendar year, I think the market would, you know, start moving up in a more secular manner. This is what I think our house view is. Of course, very difficult to take short-term calls on the market. We should not take, but that's what I believe.
Thank you. Thank you very much for the interesting perspectives that I've shared from all of you. I think one of the earliest lessons that we learn when we start investing is timing is not important. Time is what matters in the market. I think each one of you has justified and made a call towards that area. And of course, looking at the AIF PMS industry, which is around 12 lakh crores today, and we are looking at that industry growing exponentially to about 36 lakh crores in the next 5 years. I think there is a lot of merit for an investor to look at the AIF and the PMS space in a more sustained manner. And this is, and the best part is that they are running the long-term story. There is nothing short-term about the whole thing. I think at this moment, I must thank each of the panelist members, Mr. Madana Gopal, Mr. Aman Arun, and Mr. Abhisar for being such excellent participants today and articulating your views to the audience today. Thank you very much. I hope you had a great session. Thank you.